Did I detect a sense of enthusiasm, if not downright optimism, in this report from you today?
Peter, there's no question the economy has proven more resilient than we were expecting. We're seeing ingenuity from Canadians. They've found ways to work, to serve customers, to shop through this pandemic. And so we're seeing more resilience in the economy than we expected. And the economy is doing better than we expected. And vaccines are rolling out. There are better times ahead. And reflecting that, we have revised up our outlook. But I do want to underline that it's still going to take some time to get to a complete recovery. We're in the midst of this nasty third wave that is straining our healthcare in parts of the country. It's impacting the same hardest hit sectors again, particularly women and youth. Important parts of the economy remain very weak. There are too many unemployed Canadians in the country. From our perspective, the Bank of Canada, we're committed to supporting Canadians and Canadian businesses through the full length of the recovery.
I want to dig into that because I think there is a sense, I think, among most Canadians that the bank is this massive ethereal thing that they don't really understand, and they can kind of get their heads around what the federal government in the budget was saying and the supports that they're giving. Can you just answer to, some of those people you're just talking about, somebody who's a single mom at home who lost her job when the pandemic hit and hasn't been able to see that job recover yet? What role has the central bank played in helping someone like her bridge through this and to get back in towards a more normal economy?
Well, it isn't as direct as fiscal policy. It's we're not writing support checks to individual Canadians, but there are two key things that the central bank does. First of all, it keeps financial markets functioning. And at the beginning of this crisis, there was financial markets seized up. So what does that mean for the average Canadian? It means that funding markets are closed. They can't get a loan to get a mortgage. They can't get a student loan. So we provided extraordinary amounts of funding to keep markets functioning, keep markets open, so that individuals could borrow money, so firms could get money to bridge them through this, so they could buy inventories, they could pay their workers. The second thing, and since the very dark days of the crisis, market functioning has greatly improved, and actually those various facilities that we put in place, we've wound those down. What we are continuing to do, and have been doing for some time, is to provide exceptional monetary stimulus. And simply put, what that does is it lowers borrowing costs. So if you have a mortgage, you're paying less interest on the mortgage, and so you have more money left over to do other things. And if you're considering making a major purchase, a house, a car, the borrowing costs of that are lower, so it's more affordable. That encourages spending. When you encourage spending, that creates jobs, gets people back to work. That's what we're doing.
And those lower interest rates, I think for that single mom that we were just talking about, it's mostly her employer running a small business that, was on the edge of trouble when this hit, was able to benefit from a better functioning market and more liquidity in the system, right? Like you can draw a direct line through their workplace to their ability to weather the storm.
Yes, I mean, what you saw a lot of businesses do at the beginning of this pandemic is, they immediately drew on their bank lines to make sure they had a cash reserve to help them get through this. Well, the banks had to fund all that, and funding markets were closed. So what we did is we provided extraordinary funding basically to the banking system so that it could keep loaning money to small businesses and bigger businesses.
So here we are.
And Canadians.
For sure. And here we are today where you're announcing a stepping back or a scaling down of some of those extraordinary measures that were put in place at the beginning of the crisis. How does that square with, on the one hand, we have the federal government in the budget saying things are so bad we have to keep spending and the risk here is not doing enough. And on the other hand, we have the Bank of Canada saying, wow, things are actually doing so well that we can begin to take our foot off the pedal a little bit. Is there as much difference in those two statements as there might seem on the surface?
No. keep in mind, we are continuing to provide exceptional amounts of monetary stimulus. I mean, what we've done today, we've maintained our forward guidance. We've committed again to hold interest rates at 0.25%, basically as low as they can go until slack is fully absorbed in the economy and we reach our 2% inflation target. And even with a brighter outlook, we don't think that's going to happen until sometime in the second half of next year. We have adjusted our quantitative easing program. We had been buying $4 billion per week of Government of Canada bonds. We've adjusted that down to $3 billion per week. That is still an exceptional amount of stimulus. And I want to underline that the decision to reduce it does not reflect things that we think are going to happen in the future. They really reflect what we've seen, the progress we have observed in the recovery so far. And if you go back to where we started, the economy has performed better than expected in recent months. And so we don't need as much quantitative easing, but we are still adding substantial incremental stimulus at a pace of $3 billion a week.
And I mean, I've often sort of used the analogy of scaffolding for QE, that is building up scaffolding around a building that might have some structural problems that you just want to make sure it stays in place. And what we're talking about here isn't removing the scaffolding. In fact, we're still adding scaffolding, just not as big as quick a pace. I wonder at what point do you start thinking about what to do with this amount of money you have on your books and in terms of getting that scaffolding back down? Or is that such a long-term problem that we're not even looking at that yet?
Well, right now we need all that stimulus. We've still got a considerable ways to go. There are large parts of the economy that remain very weak. We need that stimulus. As we go forward, looking forward, we will continue to adjust the pace of quantitative easing, the amount of quantitative easing, in line with the strength of the recovery and the durability of the recovery. If the economy, if the recovery progresses in line with our own projections or better than our own projections, over time, we're not going to need as much quantitative easing as we have now.
The takeaway, I think, for most Canadians, most Canadians, whether you're a business owner or an employee or somebody who's been out of work, everybody just wants a bit of a map, a bit of a guideline to where we're headed. You think that we'll be back to like an inflation target and back sort of looking at those broader measures by the mid to the end of next year. What do you think the second half of 2021 is going to be like, not just for the Canadian economy, but for the Canadian employee and consumer and Canadian household?
That's a very good question, Peter. We're talking a lot about things that are well into the future. Let's talk about the next 6 months to the next year. So right now, as I indicated, we're all very aware we're in a very nasty third wave. That is going to be a new setback. We've seen last couple of months, we've seen some very impressive job numbers as we came out of the second wave. Unfortunately, some of those job gains are going to be reversed, I expect, in the next month or two. But what we saw coming out of the second wave is that as the restrictions were lifted, the economy bounced back quickly. And that has given us more confidence that, as bad as this, as tough as this third wave is going to be, as we get through it, as the restrictions come off, the economy will bounce back quickly. So, as we get, we've got April, we've got to get through May. As we get into June, we'll expect to see some rebound. And through this whole period, of course, vaccinations are continuing to roll out. So as we get through to the summer, most Canadians, or at least every Canadian who wants one, should have at least one jab. That should help protect us. And as you get, so things should begin to normalize. And as you get into the fall, we really should be getting to widespread immunity. We're assuming that most restrictions would be lifted by the end of the year. So we are expecting a pretty strong consumption-led recovery in the second half of this year. As we get back to more normal activities, we can start to do the things we want to do. And as consumption will lead, and then with that, firms will start investing more. They'll see that their opportunities are increasing. They'll start to invest more. And the final thing I'll say here is the U.S. economy is also recovering very strongly. That will increase demand for our exports. That's a big part of our economy. And when exports demand go up, that's another signal for firms to start to investing. And so if you get consumption, investment, and exports, you'll start to get a more broad-based recovery, and that's going to be something important that we'll be looking for.
And just as a very last question, and not to dwell too long on this, but we talked earlier about the fact that you guys are saying slightly different things, but towards the same goal, and effectively saying the same outlook towards the economy, the federal government and the central bank. Just on that, what's the importance of monetary policy and fiscal policy working hand in hand and working toward the same goals, albeit from different ends of the street?
Yeah, so monetary and fiscal policy, each have their own tools, and we each have our own objectives. But broadly, we all want the same thing. We want a complete recovery. We want Canadians back to work. For the Bank of Canada, we have an inflation target, and in order to get inflation at 2% and keep it there, we need Canadians back to work. If we don't have Canadians back to work, there's missing incomes, there's missing jobs. That's going to put downward pressure on inflation. So we're all working towards the same objectives. We're using our own tools to do what each of us can do. And as I said, really what the Bank of Canada does is it keeps markets functioning, and it affects borrowing rates. And by holding borrowing rates low, we are encouraging spending, which is going to get Canadians back to work and get inflation on target.
Governor, I really appreciate making the time for this. Thank you so much today.
Well, thank you, Peter. My pleasure.